Hey traders, Jeremy here coming at you for your market bias update report for Sunday, November 5th. We are about an hour before futures opens here, and I wanted to start off with a heat map from the S&P 500 for last week. Obviously, you can see tons and tons of green. Almost everything was up for the week. Some very, very big numbers. Amazon up 8.5, Apple up 5, Microsoft up almost 7, Nvidia 11% gain. So obviously the bulls stepped back in fantastic fashion. But let's go out and look at the S&P and see what was going on here. So obviously we had broken down here, tested down to the lows, set back here in like April, May, June. And it is not uncommon in bear markets to have rip your face off rallies where everything just goes up, sometimes in very, very extreme fashion. You can see we had that again here in the beginning of October and actually again here at the end of August. And it's important to understand what is happening when that happens. So when you're in a bear market, there are a lot of people that have shorted the market, and usually they are the first buyers actually to step in, and they are buying to close their short positions to lock in profits. So that starts to form the bottom pivot. And then on that, you start to have day traders that step in that see a little bit of an opportunity for a short little jump in, jump out. And then you start to have longer and longer duration traders starting to see that trend and the fear of missing out, and people start to pile in. So that's the mechanism that we saw here. Now, what is important is that we did break this diagonal resistance zone. That was really, really awesome to see that the bulls didn't just pop back up, come into the 200 period moving average and roll back over, which was kind of our base case from last week. There was a ton of resistance here, both on the daily chart and on the weekly chart. And instead of hitting their heads on that and selling and rolling back over, we screamed through that. And that was actually on the back of a lot of interesting economic data coming out in the federal fund rate. So right here, you can see on Tuesday, the 31st, Chicago PMI data came out and was actually a little bit lower than expected and also slightly lower than the previous month. So that helped out a lot. Then we had non-farm roll. Employment change came in, and that impacted the market fairly heavily as well. But the big one was the federal funds rate staying at 5.5. And Jay Powell and the rest of the Federal Reserve did decide to hold tight on 5.5, and that correlated to this big candle right here, excuse me, this one right here that actually broke through and started the bullish move there on the first. So that set the tone for the rest of the week, because really at this point, the market is starting to price in the fact that the Federal Reserve is likely not going to raise anymore. The data that came in here, the Chicago PMI, the non-farm roll employment change, as well as the unemployment claims, non-farm roll employment change down here on Friday, and the unemployment rate here, all of these basically signaled that there is enough softening in the US economy now that the Federal Reserve's job is likely done, and that the reduction of inflation from here is likely going to be taken care of by the lag effect of them rising to 5.5 very, very quickly. So it takes a while for that change to percolate into the market and start to impact the economy on a larger scale. And these numbers are starting to show that that might have gotten to a level where the Federal Reserve will no longer have to be aggressive raising their rates. So that was really, really good. And let's zoom in here on the unemployment rate. So if we click on this little graph right here, you can see that we've just barely started to see a little bit of a rounding bottom here on unemployment. And that is really, really important when we are talking about bear markets, and especially with inflation. Unemployment rate is one of the biggest impacts to inflation, and we need to see unemployment actually increase to help tame inflation. So if we go back here and look at 2008, the 2007, 2008 kind of crash, you can see at the bottom of that, if we zoom in, that to start seeing prices going back up at the end of 2008 and 2009, we really started to see this increase in unemployment start right there. We bottomed out and then slowly started to rise. And that same thing is just now starting to happen here. We're getting the first few ticks up of unemployment. So that will help with the inflation conversation and really put a very bullish sentiment into the market. So next, I really wanted to just take a quick second before we jump into actual charts to talk about seasonality. So in seasonality, let me get rid of these real quick. So in seasonality, usually in October, September going into October, we have a down draw here. Bam. And usually we actually break that support level just briefly, get a little bit of a fake out to the downside before this bullish rally going into year's end, the Santa Claus rally, so to speak. So it's interesting to see that and then go out and look here. We did break support right here. Bam. Had the little fake out, and now we've gotten back above that. So now what happens? We are obviously a bit overextended for anyone trying to buy the dip right now. We're up 1, 2, 3, 4, 5 big green bars with expanding momentum to the upside. Friday's candle was the first candle that was smaller, so we did have a slight decrease in momentum, but this still is showing a lot of momentum. I wouldn't be terribly surprised to see another candle come in here, coming up to this major pivot, the previous pivot high, and then see us kind of take a little bit of a leg back down. And where that ends, we'll have to kind of see. It's going to be very important for the bulls for us to, if nothing else, at least keep this line in the sand right here. And if it takes a few days for that bearish retracement to come back in, we might see it come back down and retest on this diagonal line right here. That would be kind of the absolute ideal scenario. We could also see the bulls come in, have that kind of candle up, and then pull back with a little flag-based pattern like this into this 50-period moving average right here, and then trigger to the upside, breaking above this diagonal line and above this pivot right here. And that would be kind of our ultimate confirmation, this break above the pivot here with some kind of a higher pivot low in this region of the market, the break back above this pivot and eventually back above this diagonal. That is going to be our ultimate signal that yes, the bulls are in control. Buyers have stepped back in at a higher level relative to the pivot down here, and hopefully back above this gray moving average right here, this 200 period moving average. We do want to see that hold. And the more days that we have as that pullback, whatever, or consolidation happens, the more this diagonal line of resistance that is now going to be acting as support and that 200 period moving average kind of converge on each other. So somewhere here around 4,300 is kind of the ideal target for me for the next pullback to set a higher pivot low and then be rock and rolling to the upside when we get another break. So that is kind of what I am seeing in the S&P 500, and that kind of correlates to right here on the chart. We got the fake out. We've got this nice big push, and usually we get a little bit of a shakeout right there before we actually break this pivot and then retest as support there. So on the S&P, we might have the little pullback here, the break back above to this longer term diagonal, a little bit of a chop, and then the ultimate breakout right there. That's kind of what we are looking for in the S&P in the ideal scenario. Okay, so that is all I really wanted to show on that. Looking at the calendar, the week ahead real quick, let's go back out and look at the upcoming week here. Wallard speaks on Tuesday, not super important. Fed J. Powell will speak on Wednesday and Thursday. Those will both be important market movers, as well as unemployment claims here on Thursday morning, early morning, and then consumer sentiment and inflation expectations. So a fairly light week comparatively to some of these previous weeks that we've had. But still very important data, mostly in the later stages of the week, mostly leaning Wednesday, Thursday, Friday. So keep an eye on those reports. If you have any active trades open, be sure to keep an eye on those because those are potential market movers. Anyways, all right, let's jump in and look at the rest of the charts here. So on the weekly on the S&P, already kind of talked about this, coming back up to that previous pivot, chopping back and forth, and then breaking. That ultimate break of this line right here is very important because it would also give us an ultimate break of this blue moving average right here. So if we can get that kind of push up, pull back, break through, and then test here, if we get any kind of form of that pattern, we will be breaking through this all-important 20-period moving average on the weekly chart and the longer-term diagonal here. So that would be really, really nice for a bullish trend to potentially move us into the rest of the year. Going out to the NASDAQ real quick. NASDAQ is very similar. We do have this overhead diagonal resistance. We are actually flirting with, excuse me, flirting with the 20-period moving average here, and actually did close the week above that, which is very, very bullish. That is great news. We do have that still above us, couple of moving averages rounding below. I would love to see us kind of take a day or two to just kind of chop back and forth here, let these moving averages come up and converge on each other right around here, and then see the ultimate breakout above this diagonal resistance zone and above this previous pivot. That would be all signs go for the bulls. So keep an eye on the NASDAQ chart. I really like the development there. Going out to, let's see, Dow Jones real quick. Similar conversation here. We do need to still break the pivot high here. Going out on the weekly. Even if we did break that, we still have kind of a little bit of chop and mess back above us out here. I'm not particularly interested in the Dow Jones right now. I honestly usually am not. I mostly trade the S&P, the NASDAQ, and then every once in a while the Russell. So let's go out to the Russell and check it out. Now the Russell is interesting. You'll see this gray box that I drew here, and that is signaling a ton of overhead resistance. So right here you can see this cluster of moving averages, the 20, the 200, and the 50, all on the weekly chart, clustered right there. And also, if we drop out to an even longer time scale, in that same gray area, we have three big major moving averages all right there. So the Russell has some serious work cut out for it to regain favor here. On the daily chart, it is really awesome that we did break back above the 9 and 20. We are kind of coming into this resistance point from back here, the support here and resistance here, as well as resistance from the decreasing 50-period moving average. So honestly, I am anticipating some chop and pullback back down into this 20-period moving average right there. So any kind of pullback into kind of this zone from back there with the 20-period moving average curling up and starting to smile at us, and then ultimately a break of that decreasing 50-period moving average. That would be really awesome to see. Also kind of coming into the same zone of a break from over here on the left-hand side from the resistance. If we get that set up, should be pretty easy to push back up into 1842 with the 200-period moving average. And then if we do reclaim that, reclaim 1442. Yeah, at that point, we would have a little bit more overhead resistance. So the next trigger I'd be looking for would be above about 1875, getting back above the 200-period weekly moving average. Ultimately, we are still just in this massive consolidation zone from below a little over 2,000 to above about 1,650. So still just kind of pinging back and forth in there. We did have a little bit of a fake out to the downside. Overall, I like what I am seeing, but I'm not super interested in this because there's so much resistance there. I would much rather play the S&P or the NASDAQ, which has 1 or 2 levels of resistance above us now instead of like 7 or 8. So let's check out gold real quick. Gold on a daily chart here has been defending its 9-period moving average, still has a little bit of work to do to clean itself up, but a break back above the pivot highs here around 2022 would be bullish, and I'd see that moving back up to around 2063. So I like the look of that and the development of that. On Bitcoin, this chart obviously is going to potentially gap one way or the other here because it has been closed for the futures over the weekend, but Bitcoin itself continues to trade. Ultimately, the same conversation from last week applies. We really want to see the 9-period moving average hold. It's okay for some wicks to be testing down below this diagonal line, but we don't want to see a daily close below this diagonal line. So as long as we can close above that diagonal line, a breakout back up here around 35,900 or 36 is still in play, and I would expect that to push up to 37 or 37.5 at the minimum. Finally, let's go out to natural gas. I've been talking about the reversal here, natural gas, beating that drum for months. Finally getting some nice upward movement in price. We do have overhead resistance here at around 3.8 that I expect to play a role. Support down here on the moving averages around 3.1. And if we zoom in here, we're just kind of getting a little bit of a consolidation, rising pennant, so to speak, there. Anything that stays above the 9 EMA on the daily chart here, currently at 3.378, is bullish and looking for a break above diagonal resistance right here. So that is it, guys. Enjoy your trading week. Trade carefully as always, and let me know if you have any questions in the comments.